Okay, so I want you to think about this for a moment. I'm just going to go ahead and isolate this real quickly so we are looking at it by itself. So I'm focused here on this value T equals, right smack in the middle of the page. I'm going to tell you that the value T, or the value at some time, T is a subscript, it just means some moment in time, Matt, is going to be a function of, or equals, in our case, the free cash flow at time one, and time one is always the next period beyond now, okay? Divided by that cost of capital or a discount rate minus G, or long-term growth rate. So FCF1 is the next period's free cash flow, WACC is a discount rate, and G is a growth rate. You've seen this before, but when you saw it, it looked a little bit different. It looked like this, and it was P, let me put the P here, excuse me, P0 is equal to D1 excuse me, D1 divided by R minus G. Does anyone remember seeing that equation in one of your earlier finance or economics classes?
Isn't that part of a formula? Like, isn't it a part of an alternative formula to find what is called?
It is. It's to find RE. You're exactly right. Okay, so this is called the Gordon growth model. And in this form, it's also referred to sometimes as the dividend growth or dividend yield model. And in this form, it is applicable to common stock for a company. Okay? The price at time zero is now, okay, is equal to the dividend that we expect to see paid the next period of time divided by some discount rate, could be WACC, could be required return, but some discount rate, minus the long run expected growth rate of that dividend. Well, there are some problems with this equation when we think about it with respect to common stock, but it's a very strong equation that we can use throughout the rest of finance, and it's why we're using it up here when I call it value at time t. I could have just as easily called this value at time zero. In fact, it might even be better to call it zero rather than t. Okay? Because the 1 and the 0 are more descriptive with each other now.
Right. So it kind of mimics it in the sense that, you know, value, although is not, you know, synonymous with price, but depending on what context you're thinking of something in, if you're trying to, you know, determine what something's value is, which is kind of what you do when you try to price something.
Right.
And then future cash flow, if you're looking at it just, you know, I think, would it be fair to say that the value T equation would be how you would actually estimate value of a company or a capital structure, something like that, versus the one below is looking at maybe a stock specifically?
Matt, you're exactly right. And therein lies the problem. I think we would all agree that all companies, if the company is an asset, and it's a complicated asset, all companies produce a cash flow, right? Now, it might be positive, might be negative. Well, I guess it's possible for it to be zero, but that's highly unlikely for it to be exactly zero, right, in any given year. All companies produce a cash flow. And you might remember me telling you the first night of class that the value of a company today is the time and rate discounted expected future cash flows in perpetuity, forever. Well, this equation is actually an algebraic simplification of a perpetual model. let me open up the time value of money quick sheet, and I'll help you see this. So focus for a moment on this model form right here. PV equals the sum of some beta t divided by 1 plus r to the t. Okay, this E, this funky E, means the sum. So all of these terms added together. And it doesn't give us a range. So when there's no range included, it's a perpetual or an infinite series of sums. So if I take beta t, and beta means benefit, this isn't the statistical variance like beta in the CAPM equation. It means the beta means benefit, and we're going to think about it as a free cash flow or a cash flow. So any beta divided by 1 plus whatever the discount rate is to the power of time. And if we have something that we're looking at, it's going to be beta 1 divided by 1 plus r to the first plus beta 2 divided by 1 plus r to the second plus beta 3 divided by 1 plus r to the third, all the way out to beta infinite divided by 1 plus r to the infinite power. Can we calculate that a value for that infinite series of numbers? Is it even possible?
Yeah, if you use the perpetuity equation, right?
Yeah. What's the perpetuity equation, Mandy?
I don't know off the top of my head.
As it turns out you do. It is your new best friend. Hang on, let me find it back here for a minute. That's your perpetuity equation. The value today is equal to some benefit, we're calling benefit a free cash flow in this case, divided by some discount rate minus the long run growth rate. Now here's a couple of things that are important. This G is the expected growth rate of the benefit. And it is never changing. So if we have, and I'm going to keep toggling back and forth between these, if we have this beta t, let's call it cash flow instead of benefit to make it easier for us, and let's call r WACC, so we put it in terms that are more familiar for the rest of our discussion. If we have these cash flows, we'll even call it free cash flow, at time 1, and then divide by 1 plus WACC to the first, and free cash flow at time 2, divided by 1 plus WACC to the second, and so on, all the way through the infinite power, we actually can't calculate that, because the moment Mario thinks he's done adding all those numbers up, Kylie, who's mean-spirited when she's upset, throws another term at him, because it's infinite. It's never ending. You can't calculate an infinite series of values. But there happens to be an algebraic simplification, and in this case, if these was an infinite series of cash flows, and if the cash flows were growing at a constant rate for that infinite amount of time, then we could capture the value in the Gordon growth model. And it's accurate out to like the 20th decimal place. And that's good enough for me.
But is that why you're minusing off the 2.5? Because that's the perpetuity, meaning just that?
If you wanted to go through the algebraic proof, we would see that it would coalesce in this. But the easy answer, Matt, is yes. The harder answer is there's an algebraic proof behind it. Okay, but this is the algebraic simplification of an infinite series of terms growing at a constant rate and using a constant discount rate.
Well, I guess that's what I mean, though, right? It's like, to your point, like on the other example, you just have to keep doing that forever the way it was set up. So yeah. It seems like somebody devised it to say, well, let's just take what the 2.5, which is our expected perpetuity rate, and just lop it off, and then you have something that you don't have to continually calculate forever, basically.
Yeah, part of the issue, Matt, here is that when we get out to like the 50th year or the 195th year, what's the value of FCF at time 195 divided by WACC minus G? It's infinitesimal because it's a percentage, or it's a decimal at some honkin' exponent. So it's infinitesimal. So it adds virtually nothing to it after 50 or 100 or whatever years.
I see.
Does that make sense?
Yeah, it's you know, for lack of a better word, its value, figuratively and literally,
Yeah.
is no longer relevant.
Right, because it's so small. Now let's look at an algebraic weakness of these equations. When applied to common stock, which is what gives us a dividend, when the company's growth rate is greater than the discount rate, we end up with a negative denominator, and that's a problem, right? When the growth rate is bigger than the discount rate, we end up with a negative denominator, which would suggest that this company paying a dividend, growing at this nice rate, it has a negative value. That doesn't make sense to us. It doesn't pass a smell test, does it? Okay, especially when, let's assume for a moment this growth rate was 2.5%. That's a low growth rate. And let's assume the cost of funds, the discount rate, was lower still, 1%. Which one of us doesn't want a dividend growing at 2.5% in an environment where our cost of capital is less than 1%? I mean, that's investment nirvana, right? Or better still, a growth rate of 10% when we have a discount rate or a cost of capital of 1%. Well, if we've got a dividend, which means we're profitable. You can't pay a dividend without being profitable. So we've got a dividend, this really small cost of capital, R, and a really nice growth rate, G, that's going to result in a negative value for this company or stock. And that doesn't pass the smell test, does it?
When you say it doesn't pass the smell test, it just means mathematically it doesn't make sense, or to an investor look at that and say, I'm not going to invest in that.
So, Carol, were you the one that reminded me that you're a nurse, or is it Diana?
It's Diana.
Diana.
I'm a nurse.
So I want you to come off of mute. I want you to be a nurse for a minute. I don't even want you to think as an investor. But I want you got to come off of mute because we're playing a game, okay? So you're a nurse. And I come to you as a investment advisor. I say, Diana, here's a company that's profitable. And all of a sudden I've got your attention, right? And it's got a very low cost of borrowing money. In fact, it borrows at a cheap rate. In fact, its cost structure, period, is just really low. And its growth rate is really good, strong. So it's profitable, it's growing, and it's got a very low cost structure, which we know means also it's got a very low risk structure, right? Does that sound like an attractive investment to you? Profitable, growing, low cost.
Yeah, a little bit.
It's the kind of thing that makes me salivate. And it's the kind of thing that in this construction would result in a negative value. So when I talk about the smell test, I'm talking about just basic intuition. I talk to my friendly nurse, not an investment person. Now, frankly, I think she's a lot more than a nurse. I think she knows a lot more than she lets on. She's got somebody peeling grapes for her here in the background, so she's got some mojo that I've never had, okay? So, but do you get my point? Smell test is intuition to me. So its first algebraic problem is it can end up with a negative value. But if you understand the interpretation of that negative value, it's not as bad as it seems. All it means is that it's growing faster than its own internal capital can support, and it needs to go out and raise money. Well, Taylor is a venture capital investor. You tell him, Taylor, low cost of funds, high growth rate, profitable. As a VC, he's willing to put money into that every which way from Sunday. Okay, that's what we want. So it's able to attract this capital. Oh yeah, it looks like it's got a negative value, but all that means is it needs more investment capital. So that's one of the algebraic weaknesses of the equation. Here's another one. Let's go down to the P0, or the price of a common stock at time zero is equal to that dividend that common stock is expected to pay in the next period of time, divided by some discount rate minus the long-run growth rate. What's the problem conceptually with this with respect to common stock? Michael Schwartz, do all businesses pay dividends?
No.
No. So does that mean that, based upon this equation, if I'm looking at Google, if I'm looking at Tesla's common stock, Facebook, none of which I think pay dividends, this equation would suggest that their common stock has a value of 0. That's a problem. So it has some weaknesses. We use it for its algebraic strength, and we understand it, and we interpret what those weaknesses are telling us. This is the Gordon growth model. So coming back to your problem set now.
I was going to add, Rick, even if it has a big growth and low borrow cost, I need to, as a nurse, I would see what company it is. Like, of course, if it sells cigarettes, I'll never. For example, if it's hospice where they put people on comfort care but they just kill them, I would never sign up for this, even though I can make so much money and if it's profitable. So I stick to my morals, I guess.
Diana, it is the company that successfully developed the vaccine to the COVID-19 virus, and it has perpetual rights to it without any release.
Okay, so then I might agree to that.
We're on, right?
Yeah.
Not like you. I mean, the numbers have to make sense, but I don't invest in companies I don't understand, and I don't invest in companies that give me some moral pause. Okay. All right. So now we can think about this, and obviously I've kind of messed with this quite a bit, but now we can look at how we got the number here. So I looked at the company's free cash flow at times 0, which was 126,024. You calculated that already. I multiplied it by 1 plus the growth rate of 2.5%. So that gave me then the free cash flow at time 1. I divided that by WACC minus G, and it tells me this company or this asset has a market value or estimated value of approximately $1,257,786.
So free cash flow 1 has to be whatever you're originally calculated as free cash flow times 1 plus the given perpetual growth rate.
Yeah. Well, it doesn't necessarily have to be in this case, yes, the perpetual growth rate.
Would you say that the FCF1 is like future cash flow in the future? I don't know if that makes sense.
No, it doesn't. This is free cash flow, and I never want you to think of it as future cash flow. Okay? Because free cash flow is so specific a term to us. But what makes it future is this 1.
That's what I meant. Yeah, okay,
Yeah.
got it. So, yeah, okay, I'm with you.
You're dead on. You're exactly right. We're going to use this equational form many times, okay? In fact, it is at the heart of most of the valuation models that we're going to explore together. We're going to use it a lot of times. But recognize that everything starts at time 0. Time 0 is now. Anytime we're valuing something, we're valuing it as a present value, and the present is now at time 0, okay? The reason we know it's time 0 is because there's 0 displacement between right now and now. Okay? All right. So,
Rick, quick question. If it would have been it could have been free cash flow 3 or 4, or is it always 1?
Andrew, that's a really good question. I'm going to give you the answer. I'm going to ask you to simply accept it, and then you're going to understand it in 2 weeks. Okay? We could have just as easily used free cash flow at time 3. But if we do that, that gives us a value as of a date and time in the future, doesn't it? Because it gives us a value as of time 2. Because the value is always the period before the time signature on the cash flow. So if we're using the free cash flow time 26, it gives us a value as of time period 25. Well, that then lives in the future, so we then have to take that number and discount it back to today.
Oh, okay.
Okay? Good question.
Okay.
Well, in this next one, all I'm doing is using an alternative interpretation of free cash flow. So free cash flow, I like it to mean no plat plus depreciation minus change in net working capital minus net capital spending. But it might mean, or it might be interpreted as no plat times 1 minus G divided by ROIC. That's one of the equational definitions of free cash flow, right? Happens to be the key value driver equational definition. Happens to be that we only use that equational definition when A, you're told to, B, you're motivating the key value driver equation, or C, you're using a evaluation multiple. None of those are active here other than you were told to use it in this case. It's just a form of free cash flow. And we're dividing it by WACC minus G, which means it's the Gordon growth model, and lets us come up with some numbers, and you've already done this. And you've noticed that these numbers are very different. 3,941,000 versus 1,257,000. So somebody remind me why they're so different. What's at the heart of them being so different? And this is something we've talked about 3 times over the last few weeks now. Anybody remember?
Is there a cash element to it, or is that a different thing we're talking about?
That's a different issue, Michael.
Okay.
But thank you for trying, okay?
Sure.
It's because of this relationship between G and ROIC, okay? In the free cash flow equation that we would put up, free cash flow equals no plat plus depreciation minus net change in net working capital minus net capital spending. If that's going to equal free cash flow, which means it also equals no plat times 1 minus G divided by ROIC, we've now introduced a couple of variables, one of which is ROIC, which have not been introduced in the other equational form. And that variable, and it's the way we employ it, is why those are so different. We're going to beat this up several times. I'd rather we not focus on this particular element any further tonight, because we will come here again and again. But I promise you'll have had more exposure to it, which means more interpretive commentary.
One quick question though, Rick, on the last question.
Please.
So I think things are crystallizing for me. If you go back up. So that when we talk about the 2 differences in the value, 2 different value equations.
Yeah.
So ultimately what it comes down to is that you're really calculating the same thing, but it's the version of the free cash flow equation you used within the overall value equation that is the difference, I guess, right? Because one of them you're using free cash flow 1, and the other one you're using, I can't remember what it said if you scroll down, but the other one you're using the no plat times 1 minus G over ROIC, but you're still dividing both of those by WACC minus the growth rate.
And when you see something divided by WACC minus G like this, it is an immediate signal to you that the Gordon growth model is in place.
Okay.
Okay? Any other questions about this particular element? I tried to return this to its original form before I started messing with it. Okay. We've just answered much of the rest of this. So what I'd like to do is I'd like to move on. And if we need to come back to some of this later tonight or in a review session or something, I'm happy to do so. But I'd like to kind of move on because there's some other elements I don't want us to miss getting tonight. Any questions before we do so?
I just had several questions in the in another Excel.
Okay, well, let's go there. I like that. Maybe I even have that open, do I? I do. So this is Mira Dravana that we're looking at, is that right? Very good, Diana. So what questions would you have that I can help you with? You're on mute.
For example, in debt, under value, when we like it's pre-VAC, when there is common preferred and the debt, and I put the equation.
The equation for what, Diana? I'm sorry.
For debt.
Okay.
It's above. It's on the right side in the corner. It's almost the last thing.
So on the right side in the corner, can you give me a cell reference based upon this?
059.
Okay, so it's what I've got selected here.
Yeah. So I put K13 plus K66 divided by K62. And
Got it.
I got
Okay.
some other value.
And what value do you have for K66? Do you have the same value I do? 31,311,430?
Yes.
Okay. So does anybody know why this is giving Diana a spurious result, one that's different than mine?
Because it's written out in millions and the other ones are abbreviated in millions, so you have to take
Yes, that's at the
a
heart.
really large number and then divide it by a million to get your smaller number.
That's at the heart of it, Kate. So Diana, I've got this number down here, and if you've got the same number, so do you. And this is expressed as a real number, a whole number, right? And we need to return this to the same scale as our financial statements. And the financial statements were in millions. So if I'm going to add some other items from the financial statements to this number, I can only add like for like. Otherwise, I get screwed up, right? So notice what I've done here. I've done the exact same thing you've done. I took K13, okay, which is the value of the mortgage. K13's up here, okay, 4.32 of the mortgages. I took that and I added it to K66, which is this fully expressed value of the bonds, but I had to divide them by a million so I could get it in the same construction as the value of the mortgages. And that's the same construction as the rest of it. You divided it by 1,000 when you took it by this K62. You needed to have taken it by a million. So this isn't the scale of the sheet. The scale of the sheet's millions. Now I could have just as easily somewhere down here put scale. I could have put a million next to it, and I could have divided it by that cell value. Does that help? You're muted.
Yes, thank you. And then another question, when I try to calculate back, I put all those, I put all the numbers for common, preferred, and debt for 2019. And then do we need to do the same thing for 2018?
You don't. I mean, you certainly could. I just haven't done so. I haven't expected you to. So this WACC is for 2019.
I don't know how to calculate this WACC because we don't know other numbers. Like we have to come, I guess, in the sheet, in the financial statement sheet, they compared 2013 and 2014, and then they calculated WACC. So I'm not sure how to calculate WACC with just with 1 year.
You only need 1 year to calculate WACC. Because you're dealing with the market value of the instruments for that year and their opportunity costs, so the R's for that year as well, and the tax rate for that year.
Okay. Okay, I guess I'll try that.
Yeah, so I believe you have enough information. You could calculate a WACC for the prior year. I just haven't caused you to do so. And you'd have a fair amount of work to get there. Okay. I say that I don't know that you have enough information because you don't have enough information to calculate the market value of the debt for the prior year. So you can't do it. You don't have enough data to do it.
Mm-hmm. And then I didn't know how to calculate operating margin in D51 and and E51.
That's the easiest thing you've asked. So right here. So operating margin, so P24 divided by P14, and what you're going to find is that's operating income, or EBIT, divided by revenue. So let me come up here, just come over. So you've got operating income divided by EBIT. Oh, excuse me, operating income divided by revenue, excuse me. Anytime you see ratios or relative values that are reflective of the income statement, they're always as a percentage of revenue. Anytime we see them as a function of the balance sheet, they're always a percentage of total assets. This is referred to as common sizing, and you probably dealt with this in MBA 602 and 603. And if you haven't had 630 yet, you'll clearly deal with it in 630. Some of you have already had 630.
Mm-hmm.
Okay?
Okay. And then one more, years, when it's 15 years, do we just assume that this sheet was done in 2019? And then in the beginning it said that the year issued 2004, so 2019 minus 2004.
Yes, that's exactly right. But the other piece of information here is that they were 30-year bonds. So it's a 30-year bond issued in 2004. So it would mature in 2034. 2019 or 2034 minus 2034 minus 2019 is 15 years.
I see. Okay.
Good questions.
Okay. Thank you.
I had a couple, Rick.
Yes.
So the coupon that you have is 5%, and then the yield to maturity is 4.75.
Okay.
Where are you pulling that from?
So when I show it right here, Mandy,
Yes.
the original inputs, it's why you don't see them shaded.
Okay.
So anything that's not shaded on this is an original input.
Yeah, so I don't know if I messed mine up or what. Mine says 14 and 6.
Yeah,
So.
you didn't mess it up, Mandy. I messed it up for you. And if you've been paying a lot of attention, I know there's been a lot that's gone on with this. You pay
On the WhatsApp?
Yeah, I've confessed. I've apologized. I've asked for forgiveness, and I've tried to right the wrong. Okay, so but I screwed this up when I was transitioning this to the to a fully online format. I missed an updating step, and it caused some of you to be confused, and I'm terribly sorry about that.
Okay, and then my other one was like the cost of preferred and cost of debt. I remember you talking about them, but when I went to do them, I got lost. Can you?
Okay, so here, literally, all we're doing, and I'm going to go to the one that isn't just values now. All I'm doing for my cost of debt is I'm referencing that cell here. And here I reference the cell we were just looking at. You could say, well, Rick, we don't need to put some of those values down here because they were up in the financial statements, and you'd be right. I just like to see them. It makes it easier for me to visualize them. Okay? So the coupon rate also came from that cell reference up here. Okay? So they're not calculated, they are simply referenced.
But the cost of preferred and cost of debt?
Okay, so cost of preferred is just as we showed you in the set a few minutes ago, is going to be the preferred dividends divided by the market value of preferred. So we got the market value of preferred here. If we scroll over, we're going to see that we took the preferred dividends.
Okay, perfect.
Okay.
Thank you.
You bet. You bet. Any other questions, guys? So it's 7:15. Why don't we take a brief break? Let's take 10 minutes. Let's come back at this at 7:25. Okay. We've actually covered a fair amount of what I want to cover tonight because we've been mixing in time value of money equation talk and Gordon growth talk and such, and that's where we were going to go tonight anyway. All right, so let's take a brief break, and I'll see you guys in 10 minutes.